IndiGo stock is holding up well. This is despite the fact that IndiGo, which is India's largest listed airline player, has reported a huge amount of loss this time. The loss is on account of the impact of the COVID second wave as well as on account of higher fuel cost. In fact, IndiGo reported Q4 loss which was 2x higher than the last quarter despite capacity as well as traffic improving on a sequential basis. The revenue decline was sharp. However, it was in line with most analyst estimates. The Q4 loss of 1200 crore was higher, led by weaker revenue per available seat kilometer as well as the forex loss of 120 crore. The overall cost per average seat kilometer ex fuel was marginally higher than estimated due to the supplementary rentals and maintenance. Higher than estimated operational capacity per average seat kilometer metrics were weaker potentially as the second wave has started to escalate. This is what JP Morgan writes in their report. In fact, rise in crude prices has also driven a sequentially higher cash burn despite elevated level of operations. In fact, JP Morgan does state that the revenue recovery for IndiGo is already priced in. Assuming normal post-COVID traffic, the stock is already trading at close to around 25x price to earnings multiple for FY23, and they hence see a limited scope for reopening trade upside in IndiGo, and JP Morgan maintains underweight on IndiGo. In fact, speaking more about IndiGo, the company has added 9 new A231 neo aircrafts and retired 11 A320 neos aircraft in the fourth quarter. Thus, the net aircraft additions were down by 2 aircrafts on a sequential basis to 285 planes. On a YOY basis, the company has added 23 net new aircrafts, retiring close to 23 A320 neos. New aircraft share has increased to 56% in FY21, and this share stood at 43.5% in FY20 in the total fleet. The company has total cash of close to around 185 billion rupees, and of which free cash flow is close to around 71 billion rupees. Restricted cash stands at restricted cash stands at close to around 11,500 crore at the end of FY21. The debt excluding capitalized operating lease liability increased 69% YOY to nearly around 4,100 crore, and capitalized lease liability was also up by close to around 27% YOY to rupees 25,700 crore. So as such, even if you look at the IndiGo, most of the airline players or even experts for the industry do state that COVID is likely to have an extended impact in terms of the aviation sector. IndiGo, being the market leader, their market share is still likely to increase, and also industry experts see further consolidation in the aviation sector. And yes, there are expectations of some amount of measures from the government. However, there is limited scope for that if you look at the government strained revenues. But so far, IndiGo stock is holding up fairly okay in trade.